Well, good evening and welcome to this live stream on the 8th of April 2025. It's Martin North here from Digital Finance Analytics. Great to have you on board this evening. Thank you very much for finding some time. I hope you didn't get caught out with the hour. I nearly did. it was used to go at 9 a.m. here 2 weeks ago. Last week it was 10 a.m. and this time it's 11 a.m. And then when I turned everything on, the computer didn't work. So that was another little challenge. It amazes me how the gremlins get in the system, but we have gremlins in my system, but I think we have gremlins in the financial system as well. Now, tonight, what I want to do is to drill into the question of where are households hurting? And we're going to use the postcode analysis to do that. It's quite a relevant conversation. You may have seen my earlier show, which was set up, I guess, as a way of preparing for this show, where I highlighted how many households are feeling the pressure and what the election is missing, particularly around housing. But before we get into that, I thought we should just briefly dwell further on the tariffs and Trump and those things, because it's an important context. And particularly, I've been very interested in the weirdness with regard to rate cuts in Australia, which has been very much to the fore over the last 24 hours or so. 4 cuts, 5 cuts, how many cuts? And I thought it'd be worth just stepping through a few little ideas here. And kudos to Cookie, who's been feeding me so many clips. I'm almost drowning in clips, Cookie. So thank you very much for all your help. It really is greatly appreciated. And claws out in Market Horror Show, good place to tectonic shift in risk under Trump. Well, maybe we'll see about that. Trump wants to return us to the 1930s. And of course, back then went through a massive recession. And well, guess what? That was triggered by tariffs in the early 30s. And then later on, it hit a really bad point. Of course, back then, workers were most manual workers and working in various factories, etc., etc. These days, it's mostly done by robots. So you wonder what all the people are going to do who perhaps won't be required if you bring the robots back to the US. But anyway, that's perhaps a side note that nobody wants to really talk about. But I think it's quite important. Of course, Trump has had some criticism, but he slams that as it's just stupid, really. It's not really relevant. And to give you a bit of a flavour of that, if you look, for example, whoops, what's happened here? Let's go there. There we go. So Trump slams the question on the fallout as so stupid. Very interesting observation there. And I think it's worth highlighting. As I said, Trump wants to return us to the 1930s, maybe. But then you've got to ask another question, which is, well, is a correction likely? So, people are talking about Steve Burns here. Looks like we're in a bear market. Trump is trying to cause a bear market so that they can get people to buy bonds and drive mortgage yields down. Then people say, well, markets crashed, but Trump plays on. Yeah, maybe. Wall Street, 500 targets, still predicting a big rally. So there are still people saying, no, don't worry. It's all going to be great. We're going to see a rise later in the year. But I think we are, to quote the Australian, we are at a crash test dummies at the moment. There's a lot of issues. And in Australia, of course, given the state of the finances in Australia, as the Australian points out, there isn't really much of a fiscal buffer, which is going to create some significant, interesting issues. Now, it's interesting that if you look a little bit more closely at what actually is going on with regard to the markets, this is the MSCI All Country World Equity Index, and you can see that it dropped off a cliff. It's come back a little bit, and that's pretty much the story wherever you look. So, for example, if we look at the ASX 200 All Ords, it's gone up slightly, but still well down. The All Ords much the same. And in fact, the story is pretty consistent. A bit of a recovery, a bit of a wobble, but still well down. The Dow Jones, of course, was significantly down, then came back a little bit. The 500 was also following a similar task, and you can pretty much look around the world and see a similar thing. The point is, markets really don't know what to make of this, and it comes back to a fundamental question about whether, in fact, this is a bluff, whether the tariffs are temporary, whether the real agenda is the tariffs, or whether it's something else. And what I think is quite interesting is when you start looking at this, what you realize is that there's a bigger set of issues in play here. And it's quite interesting if you look at the yield curves. The curves have actually done a few quite interesting things because, of course, rates dropped significantly and everybody was thinking, well, that means we're going to see considerable rate cuts. But if you look then at the story, and I'll just, for example, I will look at the, let's go to the US one, shall we? Look at the US rates. It's quite a good one to start with. This is the the US Treasury 2-year. And you can see that it went down below 3.5, but it's now up to 3.7 and still making further tracks to the north. Interestingly, the 10-year has gone somewhat similarly, down and then back up again. And indeed, in Australia, if you look at that, you can also see that the trends have mirrored to an extent that, although perhaps not so much, the 2-year, which is a predictor perhaps or a signal for where rates are going, is quite interesting, still quite low. So fascinating question there about what's really happening. And just to give you a little bit of a flavour on that, if you look here, you can see that Michael Burry said 10-year yields now higher than they were before the tariff news broke. That means that mortgage rates in the US remain elevated. That keeps pressure on home buyers. Until demand returns or rates ease, the real estate market is in trouble. I think that's quite an interesting and quite important observation. The other important observation, looking internationally, is, of course, China, who imposed a reciprocal tariff back on the US, has started by selling treasuries. And that's a very important observation because it means that China isn't just lying down and saying, well, you know, do what you like. And, of course, Trump then came back and said, right, well, if you're going to actually do that, then I'm going to impose even more tariffs. So this is quite an important issue because, of course, if in fact those bonds sell, that's going to potentially do things to the yield. And, you know, the more you look into this, the more you realize that there's a set of complications here that it's really quite difficult to come to terms with. I said on my show yesterday with Edwin and Cookie, thanks for your quote here. Those who think Trump is insane with his tariff strategy don't understand why. This is a very deliberate and controlled way to bring down rates and bond yields in the US. They have to refinance trillions in debt very soon. They want to do it 2%, not 4% indeed. And as Christopher Joy re-quoted from Goldman, the P multiples on the S&P 500 are still very high. And of course, we have a weak Aussie dollar. The Aussie dollar is still knocking around the 60. It's just above 60 at the moment if you look at the latest. And you can see that it's 60.48. And the pound is also up a little bit, but still, you know, we were at 52, 53 previously. Now we're at 47, so not good. So there's a lot going on here beyond the obvious. And what I think we should come back to is the fundamental question as to why. And remember, of course, Trump has this strategy of flooding with so much news and everything else so that effectively people get just bogged down with everything. I think that's going on again now. So there's a lot more going on than perhaps we can superficially think. And of course, if you actually think about the calculations and the way he did them, you know, these are very Mickey Mouse. They're there for a purpose. And I don't think that we know for sure whether it's going to be a permanent or whether it's going to be a strategy to get to no tariffs and all of those things. But for me, the real question is dealing with the debt and specifically the high interest rates, I think, is a critical agenda item here. Now, of course, some people have been talking about this. For example, Ackman talks about an economic nuclear winter if President Trump doesn't immediately pause his sweeping reciprocal tariffs. He's a hedge fund, of course. And interestingly, that Ekman is a staunch Trump supporter. So that's quite interesting. So as for what's going to happen, well, who knows? I think we're going to see more uncertainty ahead. But of course, a lot of the implications are very significant on households directly and indirectly. And I guess, not only would JP Morgan be talking about a global recession at 60%, that's significantly up from previously. Maybe they're right, maybe they're wrong. But when you come to actually individual households and what they're going on, not only can we talk about the end of globalization potentially, and that's all about supply chains and everything else, but I'm very interested in the implications for ordinary households, and particularly, of course, in Australia. And that's really where I want to take the conversation now, because there are some critical questions that come. Now, just in passing, it is worth noting that Roy Morgan noted that the latest market research suggested that the polls were actually moving Albanese quite strongly up. ALP at 53.5%, up 0.5% from a week ago, ahead of the LNP on 46.5%. That's on a two-party preferred. What that basically means is that maybe because of this, some will be actually thinking that maybe the incumbent is the least worst option. Now, in fact, I put a poll in the chat tonight specifically about whether your voting intentions might or might not be impacted by Trump and tariffs. I'll be interested to see what you think. I've seen some answers there already. At the moment, we've got a 45% no. And towards the end of the show, remind me if I haven't done it, I'll put the results up. But this is a very important question, right? Because it really does come to a question, not just out there, not just in the US, where, of course, the tariffs are biting hard, but also what's happening to Australia. Now, the ASX got smashed. Property stocks lose ground, and now markets are eyeing up to 5 RBA rate cuts in the turmoil. But I have to say, I think that's overdone, and I'm not sure that it is anything like as much. Mind you, super funds are saying, don't panic, don't panic. There are 35 billion of fees a year on the super funds for what, I sometimes ask. And of course, everybody's writing about these rate cuts on cars after 100 billion wipeout. And interestingly, Chalmers himself sort of sideways up to 4 rate cuts this year. So yes, we'll see about that. Cut, and more cuts. And of course, as Alex said, celebrating the risk of global recession and financial market turmoil like only Australians can do. As BK says, anything to pump the Ponzi. Breaking news, Australians to get the biggest rate cut in more than a decade. But then, of course, Alex Joyner also made the point, the markets are pricing in aggressive easings into accommodative territory this year. This is overdone. The RBA will ease as inflation allows. But is there a cause for panic? What would that be responding to? Recession risks are centered in the US for good reason. Do we think our major trading partners are going to do nothing to support their economies? And I think that's a really important point. So to my mind, spruik, cut. Property prices going through the roof is the headline, but I think it's a lot more complicated than that. And just by in passing, it's worth noting that the clearance rates were a little bit down, but as I discussed with Edwin, not excessively so. And we'll see what happens as we go into the autumn and into the winter seasons. But as SQM highlighted, the weekly asking price of properties has gone up. It's now, on his numbers, more than $2 million. That's horrendous when you think about the implications of that. And, okay, the West is best for price surges, maybe. Although you've got to be careful what you buy because, of course, as I highlighted the other day, massive amounts of shoddy building. And there's a story here for a property up in North Ryde, which is a sector I've been watching quite clearly, that's got huge issues. So if you buy a unit, be careful. And by the way, their councils are failing to meet the high-density home target approvals. But of course, spruik. Rate cuts mean rocketing house prices. Now, I want to take the conversation forward now, specifically look at what this means for households. And I don't know whether you saw this, but there was quite a nice piece. I covered it in my show the other day, specifically on what the ABC did, where they looked at the so-called two-face cities and specifically showed the issues with regard to the affordable versus unaffordable rental sector. And they showed that things moved remarkably against people in recent times. And this is really where I want to take the conversation, because if you compare affordability then versus now, it's gone pretty much off the boil. This is, of course, Perth rentals, and you can see in 2020 it wasn't too bad. In 2024 it's appallingly bad, and that's the real problem, because the bottom line is that there is a lot going on, and takes us nicely to our surveys, right? So I'm trying now to quantify some of the implications of those. And for those who haven't followed it before, the surveys, of course, are based on my rolling analysis, 52,000 households. We slice and dice the data. We can look at it as well in terms of where things might be going through our scenarios. And that means we can look at mortgage stress, the trajectory, the buying and selling intentions, the migration economics, all of that into the core market model, into the scenarios, and we can form a view as to where prices may be moving as well. And just quickly, a quick advert for my one-to-one service, which is proving very, very popular. I've got lots of people queuing to speak with me at the moment. It's an individual conversation. It's not financial advice, of course, but it is looking specifically at what's going on with regards to the data. And we can look at underlying trends in stress, home price, modelling, all those things. And you can book a time for a conversation in a suburb, for a suburb, either via Zoom or by phone, up to an hour. There's a charge involved because there's a lot of work to do, about 5 to 6 hours of work just to put one of these together. And you get a 30-page report. If you are interested, go to the blog, links are below. We're booking 3 to 5 weeks out at the moment. Anyway, let's go on to stress. Just to recap for those who may not have seen it, stress, of course, is cash flow, money in, money out. And I use that deliberately because we have to take account of things like tax rates as well as expenditure, as well as mortgage and interest rates. If households have more outgoings than income, we define them as stress. If they have a mortgage, they're in mortgage stress. If they're renting in rental stress, we look at investors as well. And that means we can look at the total financial stress in a particular area. And we look both in percentage terms and count terms. I keep saying count is a better measure probably. And by the way, in terms of spectrum of financial stress, this is actually quite a useful way of looking at it, because what it means is that we've got budget pressures on the mild end, which is where I'm measuring it. And remember, I measure it post-tax rather than pre-tax, where a lot of people do. We have missing payments, which is increasing intensity of financial stress. This is an RBA chart, of course. And then we have insolvency. Now, of course, insolvency is still very low, but on this journey from budget pressures through to missing payments through to insolvency, a lot of people are in this early stage, and that's the early stage that I'm measuring in my analysis. And that's why it's so important to understand why my approach is a little bit different from a lot of the others. Interestingly, the 30% of income, which a lot of people are using, it's not clear often whether it's gross or net, but quite often it's gross, masks the fact that a lot of lower income households are committed to a much higher proportion, 40, 50% of their income. And once you take tax out of that as well, then you're actually seeing even higher, which is why I look at it on the taxable rather than anything else. And if we look at the story of stress in March and look at rental stress first, it's 77.2% of all households. That's pretty much as high as it's been. It's dramatically high, way up from where it was pre-COVID. Mortgage stress is also very high as well. So this is a pretty consistent story. It was 32.9% of owner-occupied mortgage households then. Now it's well above 50%. And that's a real problem, because it means that households are juggling, trying to keep all these balls in the air, trying to pay their mortgage or their rent, trying to get by with everything else they're trying to do. And, as with all of these things, of course, there is a non-uniform story. This is, of course, the latest. Again, I shared this the other day. You can see there that in yellow, up from last month in pretty much everywhere, other than South Australia, where mortgage stress went down slightly, and where rental stress dropped slightly in WA. But financial stress is very high pretty much across the board. And just look at the numbers: 1.88 million households in mortgage stress, 2.3 million households in rental stress, 4.7 million households in financial stress. That's 48.1% of all households out of the 10 million households in Australia. So whilst there are a lot of households doing fine, and roughly half are doing fine, they may not have a mortgage, they may not have a rent, they may own their property outright, there are a lot of people in significant difficulty. And frankly, the policies from both sides of politics through the election campaign so far have not been anything like cut through enough to be able to make any difference. It doesn't move the dial. It sounds good. Give you a tax cut or give you a bit of leeway on your fuel costs. But really, this is now getting quite serious. And another way of looking at it, of course, if you look at the data through my cohorts, is to say that young growing families, of course, huge issues. That's where a lot of the first-time buyers are. 90% in difficulty. In the rental sector, interestingly, it's the multicultural establishment, the first-generation migrants, who are actually some of the most stressed. So even new migrants to Australia are having difficulty. In terms of the investor stress, well, guess what? It's highest in those that are actually more affluent because they've got a greater proportion of investment properties. And overall financial stress, 67.5% of young growing families in financial stress. That's a big number. And you can see there that that translates to considerable numbers in financial stress, 496,000 of young growing families. And interestingly, more than 320,000 of the multicultural establishment, the first generation Australians. So new migrants are not excluded from this, as well as, of course, those on the urban fringe and also older households too. And I will make the point that there's a bit of an uptick because there was some tax relief that came through and there were some wage rises that just came through a little, but the cost of living are still rising and making it pretty hard to manage. So what I want to do now is to go straight into the next section and start looking at some of the specific questions that I got, because of course what this is really about is what's happening down at the postcode level. And to do that, what I want to do is to switch across and share my model. Now this model, of course, is the model that I use on a regular basis, and you can see here that the full monthly story, this is Wollongong as always, includes household counts and things like who's got a mortgage, who's renting, who's owning outright, the rental stress numbers, the mixture of property, the people ratio, the vacancy rates, the gross investment and net investment yields, taxable income translates to disposable monthly income, and then we can see what the proportion is going on. And these numbers here, which in this case is 41 and 33% respectively, disposable monthly income. So just to be clear, that's the income after tax. This is the real money you've got in your bank account. And so we're seeing in this postcode, the average mortgage holder is putting about 40% plus of their income into paying the mortgage and one third, 33.5% on the rent. And then I track through our scenarios what's going on. And I will make the point, I think, that I've changed my scenario slightly this time around. The reason I've done that is because the world changed. I needed to take account of some of those changes. So I've made some minor changes, therefore, to the scenario story. And what I might do is share those scenarios as we go through, because essentially what I've done is to say, well, I do think rates are going to get cut. Probably in the best scenario, they're going to get cut in May, and they will continue to get cut through the years. In that scenario, the inflation is still going to be relatively benign, up a little, but not a lot. We're going to see unemployment not really rising, and we're going to see migration staying high. So that's, if you like, the best case scenario. My base case is that we are going to see some rate cuts, but not as aggressive. We are going to see migration beginning to shrink. We are going to see more pressure on households because their incomes are not going to grow as fast, but we're not going to see a recession. And then the worst case, which of course is the nightmare scenario, would be if in fact we started to see inflationary pressures really coming through strongly, which limits the RBA's ability to take rates lower. Unemployment starts to rise. They then do ultimately cut, but they cut too late. And we sit in a recession in Australia, and we're also potentially impacted by a global recession. So that's how that sort of plays out on my three scenarios. So what I'm going to do now is to just start looking at some of the requests that came in. Now, these requests came in before the show. And what it allows me to do is to display the question. And then so this is postcode from Sonia 6176. So I'm going to put that into the model. Okay. And then what I'm going to do is to cut across to the model. And you can see there that we're on 6176, which is in the districts of Brand and in the SA3 of Rockingham and Carnup. And it's a low count here, so that's very important to understand. Remember that there's probably a lot of new building around here, but it hasn't yet followed through. The models are a little bit lagging simply because of the data flows. But nevertheless, you can see here we've got a very high borrowing rate, 64%. We have a lot of mortgage stress, a lot of rental stress as well. We have mostly houses, and we have a people ratio that's relatively high. The average taxable is around 78,000 from the ATO and 110,000 from the census. And when you translate that into disposable monthly incomes, you can see that we get around 7,000, 29% going on the typical mortgage, 24% going on the typical rent. So not as high as some others, but nevertheless quite high. From a gross investment perspective, about 3.7%. That's, of course, the relative between the rent you can command versus the price of the property. But net investment yield is down minus 1.3. And I'll make the point that this house count is probably now understated because, of course, they're building like fury in that particular area. Okay, let me go on to the next one. And I'll switch back so that we can just look at that. So 2766 was the next one that I was asked for. And this is Rooty Hill in Sydney. So I'll put that up on the screen. And here we have 5,200 households, 24% owning outright, 43% are borrowing, 32% are renting. And you can see there that mortgage stress is at 48%, rental stress is at 93%. Got some stressed investors, and financial stress is above 50% overall. We've got 77% of houses, some units and other types of property there. We've got a high people ratio, so some families. The vacancy rate's 5. The gross investment yield is 3.4. Net investment yield, that's after all of the costs, for example, mortgage costs, management costs, etc., on the investment property, minus 0.6. Average taxable 61,000. From the census, from a household perspective, 103. When it says multi, that means that there's a bigger share than one income going on the overall income. And you can see there that that says multiple incomes are going to pay the mortgage. Gives a disposable monthly around 7,000, with 36% going on the average mortgage repayment, more than $2,600, and 29% going on the typical rent, more than $2,000. And looking at the scenarios, you can see there that there is still some upside potentially of property, best case scenario. But on the base, or the worst case, it's more likely to fall. And indeed, if we do get the worst case, I do think it'll fall because whilst rates might be cut, the broader economic scenario and high unemployment will probably keep the momentum relatively low. If I go on to the next request, this is from for postcode 3216. And this is Highton. So this is out in the Geelong in the southwest district, and the SA3 is Surf Coast, of course. 24,000 households, 35% owning outright, 37% are borrowing, 26% are renting. 57% in mortgage stress, 84% in rental stress, some stressed investors, and some financial stress, 48%. You can see here that even in the best case scenario, prices are looking as though they're going to sort of hang around and drop more significantly if in fact we do get the base or the worst case scenarios playing out. 84% of houses, small number of units are types of property there. People ratios 2.32, vacancies rate 5.8, gross investment yields 3.3, but net investment yield again is underwater, minus 1.5%. One of the reasons why a lot of investors are getting out of Melbourne, because the returns are very low there. Average taxable for the 21-22 tax year was $70,000, $89,000 for the census, giving $6,100 or 33% going on the mortgage at $2,080 and 29%, 1794 going on the typical rent. Okay, let's move on again and just keep going through the list. I've got about 20 to get through, so I'm going to try and move relatively quickly through them. Michael Cook said, if I have time, 7140. Let's give that a go. New Norfolk in South Tasmania, it says. So let's put that on. Quite a big area, but 4,900 households there, 37% earning outright, 40% of borrowing, 21% of renting. A lot of mortgage stress, a lot of rental stress. Now it says 100%, that might be plus or minus a few percent because of the roundings, etc. But it shows you there's a lot of people there in difficulty, and the financial stress levels, 62%, which is very high. As we'll see in a second, the problem here is disposable incomes are relatively low in Tasmania. The story here is that we've got mostly houses. I think this percentage is right, but the count might be understated. Not quite sure there. 14% vacant, 5.4% gross investment yield, net investment yield is 0.9. Bit of a lower people ratio, but the average taxable, this is the critical point, 54 and 62 respectively, giving a disposal monthly of just over 4,000. So a third on the mortgage and just under a third on the rent is the story there. And you can see here that I can't see in those scenarios how prices, even in the best case scenarios, are likely to rise anytime soon. May change, but not immediately. If I go on to the next one, so Daniel asks about 5158. And this is Hallett Cove in the Adelaide city suburbs. And there we've got 10,000 households. We've got a third owning outright, 52% borrowing. It's a very high percentage. Small number renting relatively. We've got 36% in mortgage stress, a lot of rental stress, and some financial stress. 95% of houses, small number of units on the types of property. The people ratios showing it's probably families as well as just individuals. Vacancy rate's 3.7. The gross investment yield is 4.3, and net investment yield is positive by 0.5%. Average taxable 64,000 versus 96,000, so multiple incomes going on the mortgage, giving a disposable of $6,400 with 29.8% going on the typical mortgage at 1920 and 28.6, 1843 going on the typical rent. From a scenario perspective, there is still upside potentially in the this area, up 14% over 3 years potentially, but on the base or worst case scenario, more likely a fall, and units following on. Okay, let's go to the next one, 3465. And 3465 is Maryborough in Victoria in the district of Bendigo. 4,700 there, 47% owning outright, 27% borrowing, 24% renting. So a lower mortgage exposure, but nevertheless, those in mortgage stress are very high, around 100, and rental stress about 83. Remember, it's on cash flow here. It doesn't mean they're going to default tomorrow. It just means they've got a problem balancing the books, as it were. 89% of houses, small number of types of units. We've got a people ratio of 1.92, so a bit lower. So maybe some individuals, some solo families there as well. Vacancy rates 9.7%. Gross investments 3.4. Net investment yield 1.4. Average taxable 52 compared with 47,000 for the household census, giving a disposable monthly of 3,400. Hence, 37% going on the typical mortgage, or 34% going on the typical rent of $1,200 and $1,190 respectively, and scenarios show, as I say, falls ahead. Okay, let's keep moving along. So Kerry T asks for 4870. And that's in Cairns region. And interestingly, 29,000 households in the region, 24% owning outright, a third are borrowing, 41% are renting. We have mortgage stress at 37%, rental stress at 38%. Some stressed investors, but overall financial stress at 31% is a little lower than some others. 59% of houses, some units there as well. People ratio is just above 2. The vacancy rate is quite high, so that could be Airbnb and holiday accommodation as well, of course, in the area. Gross investment yield 4.2. Net investment yield is just positive at 0.1. 67,000 according to the ATO for the individual, and the typical household at 78, giving a disposal monthly of just over 5,500. So 34% go on the typical mortgage, 27% going on the typical rent. Looking at the scenarios, you can see there that the scenario is still quite positive on the best case scenario, up another 20% over the next 3 years. Same for units, slightly lower, but in the same direction. And even the base case still has a small rise. Worst case, of course, though, a fall. Okay, going to the next one from Sally. Sally asks for postcode 2577. And that's Robertson in New South Wales. And you can see there that we've got 6,800 households with 43% owning outright, 35% borrowing and 21% are renting. A lot of mortgage stress at 85% and rental stress at 83%. And looking at the scenarios there as well, you can see that prices may rise in the best case scenario, but likely to go down in the base or the worst case scenario in the months ahead. 91% of houses, small number of units, other types of property. People ratio is above 2. Vacancy rate is quite high, possibly second homes there. Gross investment yield is 3.1. Net investment yield is minus 0.6%. Average taxable 77,000 or 86,000 for the census, giving a disposal monthly around 6,500, with 36% going on the typical mortgage and 30% going on the typical rent. Okay, let's go to the next one. This is Bathurst 2795. Okay, this is going there. This is Raglan in the central tablelands, quite a large area, including places like Wattle Flat and West Bathurst. And Bathurst itself, of course, 17,000 with 34% owning outright, 35% and 30% renting. Not much in the way of mortgage stress, but quite a lot of rental stress. Prices could well rise over the next 3 years, best case scenario by 17% cumulatively, and units in the same trajectory. Base case, not so much, and the worst case, a significant fall. Houses, 85% of houses, some units and types of property. People ratios, 2.25%. Relatively high vacancy rate, and I've got no investment information on this postcode. 67,000 is the taxable income, 82,000 from the household census, giving a disposal monthly around 6,200, and a third going on the typical mortgage, more than $2,000 a month, and 25.6%, 1,500 going on the typical rental property. Another request here relating to Geraldton. That's postcode 6530. We have had an insane rise in house price over the last year. It looks great on paper, but it's made it impossible for young buyers to enter the market. A lot of properties here are now Airbnb, compounding the homeless problem in town. Spot on. Airbnb is part of the problem, not part of the solution. I agree with that. Looking at the data, 13,000 households, a third own outright, more than a third, 36% of borrowing, 31% of renting. Mortgage stress and rental stress, not too huge, but still significant. You can see here that the scenarios are for still more rises in value over the next 3 years cumulatively, both the base and the best. The worst would show a fall, but 85% of houses, some of these types of units, people ratios above 2, but the vacancy rate is very high. That's Airbnb absolutely is part of that problem. Gross investment yield's 4. Interestingly, net investment yield is negative, minus 0.4%. Looking at the taxable income, 72,000 versus 77,000, giving a disposable monthly around 5,300, with a third going on typical mortgage 1820, 23%, 1245 going on the typical mortgage, rental payment. Okay, now the next one is from Bacon Sandwich. What a name for a YouTube user. I love it. Love a bacon sandwich. Okay, you're asking for 2251, which is on the Central Coast around McMaster's Beach. 13,600 households with 41% earning outright, 41% borrowing, 70% renting, 37% in mortgage stress, 9% in rental stress, some investor stress, overall financial stress 38%. You can see here that the scenario suggests that prices could rise by around 10% over the next 3 years. Best case scenario, but fall in the other scenarios. 82% of houses, but some of the units there as well. 2.2 is a people ratio. The vacancy rate's quite high. That's Airbnb and holiday accommodation, second homes, all that stuff. And you can see here also the gross investment yield's at 3.4, but net investment yield is minus 0.8%. And the taxable income, 78 versus 89, gives a disposal monthly of 5,700 with a 45%. That's very high, going on the typical mortgage, and 38% going on typical rent. And I'm seeing this in the Central Coast, particularly with more limited incomes and very high mortgage and rental payments. There's a real pressure in the area. Another request here, 6053. And this is Bayswater in Western Australia, northeast Perth. 6,600 with 27% earning outright, 44% of borrowing and 27% of renting. A third in mortgage stress, 71% in rental stress. Overall financial stress of 38%, which is more than 2,500 households. Scenarios suggest that on a best case scenario, prices might rise by 18% over 3 years cumulatively, but could fall under the base or worst case scenario. 80% are houses, 3.8% are units, 60% are other types of property. People ratio is just above 2. The vacancy rate is quite high. And the gross investment yield is 4.1. Net investment yield is minus 0.2. From a taxable income, 82,000 versus 105,000 from the census, giving us gross monthly of around $6,500 at 36% going on the typical mortgage. Ooh, that's quite high, 2,400. And 26.6% at 1,745 going on the typical rent. The next one is from Kathy, and she's asking for 3012. West Footscray, which is correct. It is West Footscray. I always hold my breath when somebody quotes a postcode at me and a location. Mostly it's right. 11,400 households, 21% earning outright, 37% of borrowing, 40% of renting, 83% in mortgage stress, the same in rental stress. Overall financial stress is very high at 71%, so no surprise to see the scenario still in negative territory, even in the best case scenario. 55% of houses, also unit types of property there as well. People ratios is above 2. The vacancy rates are high at 10. Gross investment yield is 3.2. Net investment yield is very negative, minus 2.3%. I keep saying this, but Melbourne is not looking good from an investment perspective. Taxable income, 74,000 versus 103,000. So again, the multi-flag comes up, giving a disposal monthly around 7,500. A third going on a typical mortgage, 24% going on the typical rent. And so it goes on, really. Any chance? Next one, any chance of 5165? That's Christie's Beach, and that's in the Adelaide city suburbs. 2,700 households, 26% earning outright, 30% borrowing, 43% renting. A lot of mortgage stress, quite a lot of rental stress, 69%. Overall financial stress above 60%. And that gives a scenario that says there is still upside, 11% over 3 years on the best case scenario, but no, not on the base or the worst case, more like falls. And houses, 77%. Houses, some units and types of property. People ratios 2. Vacancy rates 8.7%. Gross investments 3.9. Net investment yield minus 1.5. Interestingly, I see that in a number of these areas around Adelaide now where the investment yields don't work anymore. Taxable is 56 and the household census 62, giving a disposable monthly of 4.492, 4,492, I should say, with 37.3%, 1,674 going on typical mortgage and 36%, 1,619 on the typical rent. I make the point here that the rental and mortgage payments are getting very close together. So perhaps in some cases people could think about mortgaging rather than renting if they can get the loan they need. Okay, Bella asked for 3,478. There's a low count and it's in around the Bendigo area. 1,255 households, 51% earning outright, 29% borrowing, 90% renting, a half in mortgage stress. And that's about the story with financial stress pretty low. Scenario is could be a rise, best case scenario, but otherwise a bit of a fall ahead. 94% of houses, and the people ratio is lower, 1.69, so perhaps some individuals there. 16.8% vacant. And I haven't got any information on the investment yields. Average taxable, 54,000 versus 48,000, giving a disposable of about $3,546, 29%, just over $1,000 on the mortgage, or 26%, $922 going on the typical rent in that area. Okay, David asked for postcode 3146. And that's Glen Iris in Victoria. 10,600 households, 37% owning, 34% borrowing, 27% renting, 64% are in mortgage stress, 72% in rental stress, and a third, just under a third, stressed investors, giving a high financial stress rating of 58%. No chance of a price rise on my scenarios, on the 3 scenarios there. 54% houses, some units, and 2.28 the people ratios, 10% the vacancy rate, 3.7% gross investment yield, net investment yield minus 0.2%. Average taxable, 126,000 versus 129,000, giving a higher disposal monthly around $8,000 with 41.8% going on the mortgage, 3,396, and 27.6% or 2,243 going on the typical rental payment. Okay, the next one, 5097. This is Redwood Park in Adelaide, and 5,900 households, 35% earning outright, 47% borrowing, 70% renting, mortgage stress at 27%, rental stress at 55%, overall financial stress 23%. Scenarios are looking quite positive for prices, both the best and the base. Worst case, no, there would be a fall. 85% of houses, some units there as well. People ratios 3.23, so families. 4.6% the vacancy rate, 4.3 gross investment yield, positive net investment yield 0.5. Average taxable 60,000 versus 81,000 on the census, giving the multi-flag disposal monthly 5540, 32.5% going on the typical mortgage at 1,800 and 30.1%, 1670 going on the typical rent. Okay, we're close to the end, but just a few more here. We're being asked by this pop or whatever for 6120. And this is in the Mandurah area in Western Australia. 32,000 households, 35% earning outright, 36% of borrowing, 27% of renting. Mortgage stress, 23%. Rental stress, 75%. Some financial stress as well, 35%. Scenarios are best case, still a price rise, but the base and the worst, possibly a fall. Mostly houses, but some units. People ratios are low, 1.87. High vacancy rates, second homes, Airbnb, holiday accommodation, etc. But quite high there. Gross investment yield is 4.2. Net investment yield is 0. Taxable income, 74 versus 63, giving a disposal monthly of 4,300, with 46.6% going on the typical mortgage, just over 2,000, and 34.5, 1,495 going on the typical rent. Okay, the next one, 3860, is Mafra in Victoria, in the Latrobe area. And here we have 3,100, with 41% earning outright, 39% borrowing, 18% renting. And you can see here that 68% in mortgage stress, a lot of rental stress, overall financial stress, 48%. 94% are houses. People ratio is just below 2. The vacancy rate was quite high, 14.9. Gross investment yield is 3.3. Net investment yield is minus 1.7. So again, the Melbourne problem. 63,000 versus 68,000 on the incomes, giving a disposal monthly of just over $5,000 on average, 31% going on the mortgage, 1,560, and 24.9, 1,245 going on the typical rent. Yeah, Jack, I've got your request. Just let me finish these first and then I'll come and make sure I cover yours, all right? So don't keep asking. No need to keep asking. We'll get to it. Okay, this is from Noah, 6280. Okay, West Bustleton. And here we have 12,400 with 36% earning outright, 37% borrowing, 26% renting. Mortgage stress 24, rental stress 50, overall 24.1% in financial stress. Scenarios are still looking fairly positive, up 22%. Best case scenario for houses, base case, small rise, and a fall worst case scenario. 87% of houses. The vacancy rate was very high at 17.2%. That could be Airbnb, second homes, holiday accommodation, all those things. 3.9% is the gross investment yield, minus 0.2 is net investment yield. Average taxable 67 versus 71,000, giving a disposal monthly of 4,776, with 43.5% going on a typical mortgage, just over $2,000, and 36.5%, 1,745 going on the typical rent. Okay, the next one on the list is 3198, which is Seaford in Victoria. And here we have 7,700 with 28% owning outright, 38% borrowing, 33% renting, 67% in mortgage stress, 85% in rental stress, 58% in financial stress overall, and falls, I'm afraid, across the board. Looking at the scenarios, 73% are houses, and the people ratio is just above 2. The vacancy rate is 7.7%. The gross investment yield is 3.3. Net investment yield is minus 1.1. Average taxable 66 versus 78,000, giving a disposal monthly of $5,800, with 38% going on a typical mortgage, 2,220, and 30%, 1,749 going on the typical rent. And this is the last one from the earlier chat. Postcode 3195. Here we have Mordalak, or something similar, including Braeside, Parkdale and Waterways. 14,800 households, 34% earning outright, 44% of borrowing, high mortgage belt again, 21% renting, 4% in mortgage stress, 93% in rental stress. So overall financial stress about 26. Small rise, possible scenario in the best case, otherwise falls ahead with 60% owning houses, more units as well there. 2.46 ratio, people ratio, so some families. 5.9% vacant, 3.4% gross investment yield, 0.9% negative net investment yield. Taxable income, 84 versus 114, so multiple incomes paying the mortgage, more than $7,000 a month average income disposable. 37.3% going on typical mortgage, 2640, and 29.6 at 2098 going on the typical rent. So there you go. That's the latest there. Now let's have a look at some of the chat questions and see what we had with regards to questions. So Jack specifically, let's put that on there. There we go. Postcode 7000. Let's put 7,000 on. North Hobart. And I'm going to take that off so you can see it and then cut across to that. There you go. So this is postcode 7,000, 6593 household. A third, just under a third down outright, 26% of borrowing, 43% of renting, 47% in mortgage stress, 60% in rental stress. Financial stress of 49. Scenarios are that the best case, a small rise for houses and for units over the next 3 years, but the base in the worst case says no. 61% of houses, 26% plus of units. People ratios 2. Vacancy rate's quite high at 10.6%, so that could be some Airbnb and other properties there and holiday accommodation, etc. The gross investment yield is 5.2. Net investment yield is positive 0.3. Average taxable 76. Compared with 96,000 for the household from the census, giving the flag as a multi, and 6896 average disposable monthly income with 32.2% going on typical mortgage at 2222 and 28.9% at 1993 going on the typical rental payment. Okay, so that's that one. Let's see what else we can find. I saw a couple of other ones. Jason asked for postcode 2600. There we go, in the ACT. And here we have 3,668 households with 40% owning outright, 29% borrowing, not 29% and 29% of renting as well. 50% in mortgage stress, 83% of rental stress, some investors as well, 48%. Scenarios are maybe a small rise, best case scenario for houses and units, but otherwise a fall over the next 3 years. Half are houses, but there's quite a lot of units there too. People ratio is just above 2. Vacancy rate was 9.5% when the census was done. 4.9% gross investment yield, 0.7% positive for the net investment yield. Multiple plan, but look at these incomes: 139,000 from the individual, 156,000 from the household census. Incomes in the ACT, of course, particularly in the public sector, are quite strong. That gives a disposable monthly of $10,900 with 31% or 3,383 going on the typical mortgage and 24.7% at 2,691 going on the typical rent. And I must say that it really, if you compare and contrast this area of Canberra with some of the others we looked at, just how much more affluent Canberra actually is for many people. Not everybody, but for quite a few people in the area. Okay, another request came in from G2 Cali. Tarragon. Let's put that one in. 3844. Okay. Well, we agree. It is that area. 13,000 households, 35% owning outright, 40% borrowing, 23% of renting, 80% in mortgage stress, 80% in rental stress, significant pressure, financial pressure, 54%. Scenarios are falls across the board on our scenarios. 87% of houses, some units, the types of property, 2.81 the people ratio, vacancy rate of 8, Gross investment yield is 3. Net investment yield is minus 1.7. Again, it goes back to my thesis about Victoria having a real problem with their investment properties. Average taxable 71 versus 80 for the census, giving a disposal monthly of $5,800, with 27.2, 1589 going on the typical mortgage, and 23.5, 1380 going on the typical rent. Okay, Benny asked for Appin 2560. Okay. And of course, that does include quite a few areas around there. 2560, 30,000 households, 24% owning outright, 39% borrowing, a lot of building going on there, of course, 36% renting, a lot of mortgage stress, a lot of rental stress, and overall financial stress. I think this is the highest we've seen, 79%. So the best case scenario, maybe a small rise over the next 3 years for houses and units, but more likely falls. 78% of houses, some others are units there as well, 2.64 ratios. For people there, the 5.2% vacancy rate, 3.4% gross investment yield, net investment yield is minus 0.6%. And the average taxable, 61,000 versus 83,000 on the census, giving a disposable monthly income of 5609, 42% going on the mortgage, 2400, 33.3%, 1894 going on the typical rent. And I will just, if I may, remind you to like the show here. I don't do this that often, but please like and subscribe. It really helps to get these shows noticed. And I really appreciate those who are supporting us, whether you do it via Patreon or via our other mechanisms. We'll touch on that a bit later, but please remember to like the show. Okay, let's go down the list, see whether we've got any others. Otto also said, please like the button, hit the like button. Absolutely, Otto. Nice to see you. Thank you for that. Canberra is cold in more ways than one, said Alison. Very true. MD asked for 4210. You can see there, 7,800 households, 19.8 out owning outright, 59% borrowing, 20% renting, 21.9 in mortgage stress, 9% in rental stress, overall financial stress 36. Still a scenario on the upside for houses, 15.7% over 3 years and slightly less for units, but the base case and the worst case suggests a fall. Houses, 83.5%. People ratios 2.87%, vacancy rates 4.1, gross investment yields at 4.4, net investment yield is positive 0.1%, average taxable 69,000 versus 110,000 for the census. That gives a disposable monthly around 6,778, with 35.4% going on the typical mortgage and 33.8% going on the typical rent, $2,400 versus $2,298. Okay, JJ Johnson asked for 3056. 3056, which is Brunswick. Just going to take a sip of water, excuse me. Doing the show on my own, of course. I don't have anything to deflect when I want to take a drink. So here we have 11,900 households, 24% owning outright, 27% are borrowing, 48% are renting, 51% in mortgage stress, 9% in rental stress. People overall in financial stress, households in financial stress 64.5. Very little chance of upside. Again, the Melbourne problem. 35% of houses, 35% of units are types of property there. You can see there the people ratio is lower. So that could be some individuals, maybe students, perhaps as well there. 12.6% as well in terms of vacancy rates. It's quite high. Of course, at the census, there were students away, and that could have been part of it too. Gross investment yield 3.3, net investment yield minus 1.4. Average taxable 82,000 versus the census $108,000, giving a disposal monthly of $7,600, with a third going on the typical mortgage, $2,587, and 28.6% going on the typical rent, $2,198. One Burgo said, I slapped the like button, and I saw you'd asked for one. Let me try and find that one as well. Saw it up there. Where was it? I've lost it. There you go. I knew it was there somewhere. Please, can you do 872? Oh, no, I can't. Sorry, I don't have enough data in that particular postcode. It's obviously one of the smaller ones in the Northern Territory, which means that they're actually very low in terms of the sampling. So I suspect I don't have data on that one at the moment. Try another time, because they do come and go. Depends on the survey that I'm running at the time. The big ones get done every month, but some of the smaller ones don't get picked up. Remember, it's a 0.5% sample, and that means that sometimes we just have to pass some smaller postcodes. Okay, we've got this one though, Mount Druitt, and that is a big postcode, and it is worth looking at. I'm afraid that this is not good news. 20,000 households, 20% are owning outright, 29% are borrowing, but 50% are renting. Mortgage stress, pretty much everybody. Rental stress, 88%, so very high. Households in financial stress overall, 80%, so it's one of the highest that we've seen. Now, there is, in the best case, a small rise, but frankly, over the next 3 years, more likely prices will slide. 76% of houses, small number of units are types of property. People ratio is higher, so that's families. Vacancy rate 6.7. 3.4% gross investment yield. Net investment yield is minus 0.8. Shh, be quiet, Luna. Sorry, that's the dogs going off. No, be quiet. Sorry about that. It's the postman, I think. Sorry, that was the postman. Dear. Again, I can't do much when the dogs go off other than mute the mic. Okay, where was I? Yes, just looking here at the tax disposable, 53,000 versus 68,000, giving a disposal monthly of 4,793. So that's one of the lowest we've seen, of course. 45% going on a typical mortgage. That's really high, 2,160. And a third, 1,595, going on the typical rent. So shows you the depth of the problem in that particular area. Right. Josiah asked for 3219. This is Whittington around Geelong. And there we've got 9,300 households, 31% owning outright, 31% borrowing, 30% renting, 92% in mortgage stress, 82% in rental stress, overall financial stress, 63%. Falls under the scenarios, mostly houses, people ratios just above 2, the vacancy rate 6.1, gross investment yield is 3.2, the net investment yield is minus 1.9, giving $61,000 versus $63,000 on the ATO individual versus census. That's a disposal monthly, again, low disposal monthly of 4,719, with 35.8% or 1,698 going on the mortgage and 32.2%, 1,520 going on the typical rent. And I will just make the point briefly that the point of pressure is in this lower income quartile of households. I see that quite a lot, but it's not exclusively there. So some of the more affluent households with bigger mortgages also have issues like we saw earlier on. But it is this lower income group. And one of the points that I want to highlight is that politicians don't get this. They don't understand just what it's like to be in that group. And it's a large group. And I'm afraid that I think a lot of the policies being spruiked at the moment for the election are just missing the mark because they don't understand where people actually are in their financial journey. All right, let's have a look. What else have we got? MCM asked for 3056. We'll put that on. I think I may have done that. That would be 3056 is Brunswick. Did I do Brunswick? You see, I don't keep a record because that would take too long to keep a record. So, whoops. Let's go there. Okay, well, I'll just put it up again just in case that you missed it before. This is Brunswick 3056. 11,900 households. 24 own outright. 27% borrow. 48% of renting. 51% in mortgage stress. 90% in rental stress. Households in financial stress, 64.5%. Falls, I'm afraid, from a scenario perspective. 35% units and more are, 35% houses, 34% units, the types of property. So it's very mixed there. Lower people ratio. Vacancy rate's a little higher. 30.3% gross investment yield, minus 1.4. Net investment yield, again, it's negative. Taxable income, 82,000 versus 108,000 from the census, giving a disposal monthly of around 7,680. A third going on a typical mortgage, 2,587, and 28.6% going on the typical rent, 2,198. Okay, let's have a look. Let's try this one. 872. No, sorry, I can't do 872. It's just too small a sample. I tried. Sorry, one Burjo. It's just the way it is. It's the tyranny of large postcodes with big households. Okay, Jump for Joy says 6027. Yep, can do that one. If I can push the right button. There you go, get rid of that so you can see it. Okay, this is in Heathridge in the district of Curtin in Western Australia. We have 16,000 households, 32% owning outright, 46% borrowing. This is again one of those growth corridors. 21.7% are renting, 47% in mortgage stress, 8% in rental stress. Some stressed investors, 46%. Scenario suggests there's still upside in the best case scenario, but less so with the base or the worst case. 85% are houses, and it's one of other types of property there. The vacancy rate 6.4. The gross investment yield's 4, and net investment yield is flat. Average taxable 78,000 compared with 104,000 from the census, so the multi-flag comes up. And that gives a disposal monthly income of 6,627 with 36.2%, $2,400 going on typical mortgage, and 28.6%, 1,894 going on the typical rent. And I just want to acknowledge what Otto's just said because I think it's really important. It's pretty hard to get an Australian politician to understand the financial stresses of poorer households where their perks depend on them not understanding. Yeah, I absolutely agree that that is the case. And the problem is they're just in another world. And of course, we've got a lot of affluent households who are also saying, don't see the problem. And that's the issue that I see. So, I'm more and more worried about this distortion between the haves and the have-nots and the social cohesion that's falling apart. And, frankly, the journos, most of the journos have no idea either because they're on the sort of, they're getting paid quite well, thank you very much. So this is a real problem. And that's why I'm so disappointed with the quality of the current debate. And even on Q&A, if you saw that on Monday night, well, it was not particularly insightful in my mind. Nobody really got to the heart of the issue. So it's a real problem. I have to say I'm quite annoyed with how they're going on. And if the bottom line is, I think that there's just an inability for them to understand, but also, of course, to really tackle this issue without letting property prices settle quite significantly, that's a challenge, of course, as well. Nobody wants to be elected when you're seeing prices go. So, that's just the way it is. Click asks for 2753. I think we're going to get another dog bark in a second. I can hear another car. The Luna's hearing is extremely sensitive, so I apologise if I have to go quiet for a second while while the dog barks. Anyway, let's put this one up. I want to go there. Be quiet, Luna. It's like playing Russian roulette with a dog. 6,500 households, a third own outright, 37% are borrowing, 29% are renting, 6% in mortgage stress, 87% in rental stress, overall financial stress, 51%. There is a scenario where prices rise, 8% over 3 years, best case scenario, but on the base of the worst, more likely a fall. 82% of houses, small number of units. The people ratio is high, so that's families. 5.8% vacancy rate, 3.2% gross investment yield, underwater from an investment perspective, minus 0.2%, no pun intended with regard to Richmond and Windsor. 69,000 average taxable, 96,000 household census. So multi-flag comes up, giving us a disposal monthly around 6,935. 37.5% going on the typical mortgage, $2,600, and 28.7%, 1,993 going on the typical rent. There you go. That's that one. What else have we got? Anthony asked for 3155. Which is Boronia in Melbourne. 10,000 households, 29% earning outright, 41% borrowing, 28% renting, 32% in mortgage stress, 87% in rental stress. Overall financial stress of 42%. And you can see there that there is a small scenario of rises in this postcode, but only 2% over 3 years. But the base and the worst is a fall. 71% of houses, some other units, not property there as well. The people ratio is showing families, 5.5% is the vacancy rate. Gross investment yield is 3.4%, but again, net investment yield is minus 1%. Average taxable 63,000 versus 84,000, giving a disposal monthly of 5,438, with 41%, 2,244 going on typical mortgage and 34%, 1,873 going on the typical rent. And again, these outer suburban areas is where a lot of the pressure is, unfortunately. And again, I have to say, it's not where politicians want to really be talking about things, because it's particularly bad. Okay, Meech says, can you look at 6004? Been hearing a lot of stories of people selling at a loss or selling without making any gains. Rents consistently increasing as well. Yeah, well, I think that's all true. Let's have a look, 6004. Yeah, East Perth is there, so we can look at that. 6,000 households, 16% earn outright, 21% borrowing, but renting, 62%. No real mortgage stress, but there's rental stress is huge, 76%. That's putting stress on the investors, and overall financial stress of 56%. So the scenario says it could be a rise in the best case, but on the base of the worst, a fall for the values of the next 3 years. Mostly units, only 3.8% of houses. So you can understand the type of situation there. Probably some students perhaps in there as well around Curtin, possibly so. Vacancy rate was very high at 20.9. Students were away, of course, at the time because of the census. 5.3% gross investment yield, minus 0.3 net investment yield. Average taxable 91,000 versus 104,000, giving a disposable monthly of 6,795, with 34% going on the typical mortgage 2,340 and 30% 2,044 going on the typical rent. All right, let's have a look. Have I missed any? Did that one. I think I've pretty much done them all, which is good because I'm running out of voice and running out of time. Yeah. All right. So a few things to say. If in fact you didn't have a chance to ask for a postcode tonight and you still want the one-page picture, this picture here that we've been sharing tonight, like this, it is available, and you can get it by sending me a message via my blog, and I will send you the one page. Please don't ask for lots, but I'm happy to send it. Or if you'd like to get the whole set, you can subscribe, and that's more than 2,000 postcodes via my Patreon program, and I'll mention that towards the end of the show. Otto says, Martin, you've missed 2071. Now, is that a lol or is that a real one? Let's have a look. I take it at its face value, Otto, as it's you. Kilara, yes, we haven't done Kilara, have we? All right, let's put that one back up. Kilara. Okay, 4950 is the count of households. 41% owning outright, 35% of borrowing, 23% of renting. Mortgage stress, 10%. Stress in rent sector, 75%. Stressed investors, 42%. And we have financial stress at 36%. There is a rise of prices possible, 11% over 3 years, best case, slightly less for units, but the base or the worst case says no. 63% of houses, 34% of units, and other types of property. Vacancy rates, 9%. 3.5% gross investment yield, minus 1.1 net investment yield. I have to say, how many investment yields are negative? It's quite amazing, really, when you look at it. Average taxable, 137 versus 147, so affluent. And that gives a disposal monthly of about $8,000, 51.5%, more than $4,000 going on a typical mortgage. Oh, that's high. And 40.1% going on typical rent. So this is an example of an area where there is financial pressure, but of course it's not so extreme because of the fact there's more income to start with. Okay, and Jason, thank you so much for the super chat. Really appreciate that. As always, thank you very much for your support. It really does make a lot of difference to me being able to do these shows. Now, Daryl asked for Bunbury 6230. Yep, happy to do that one. Let's put it back up. Slides. 18,700 households, 29% earning outright, 38% borrowing, 30% renting, 2/3 in mortgage stress, 88% in rental stress, financial stress at 60%. There is some scenarios on the upside, but not dramatically so, and more downside on the base or worst case scenario. 80% of houses, some units there as well. People ratio is a little lower, but perhaps some families. Vacancy rates a little higher, perhaps second housing and holiday homes, Airbnb, that sort of stuff. 3.5% gross investment yield, negative 0.4% net investment yield. Average taxable 72 versus 76, giving a disposable of just over $5,700 a month. 31.7% borrowing, 26.1% renting. That's 1,820 versus 1,495. Okay, Alison says, I'm getting tired. Good night until next week. Yeah, well, I know that feeling. Thank you very much for spending some time with us, Alison. Have a good evening. And Swas asked 2025. 2025. What's 2025? Let's have a look. Wallara. Okay, we'll just do Wallara to close, shall we? Okay, so this one's 3,200 households, 38% earning outright, 26% borrowing, 35% renting. Borrowed in rental, mortgage stress 8%, 56% in rental stress, some stressed investors, and financial stress at 53%. You can see there that there is some upside, but limited upside based on the scenarios. Some houses, but mostly units, 50% of units plus. Vacancy rate was quite high when the census was done. 3.6% gross investment yield, minus 1.2 net investment yield. Average taxable, look at this, 228,000 versus 156,000 on the household, giving disposal monthly of well over $8,000, 53.8% versus 37.8% going on the mortgage and rental payments. Now, I would say, of course, these sorts of households have massive ability to manipulate their income. So my guess is the income's probably bigger than is reported there. As you say, Smooth, the Woollahra income is massive. Yeah, how the other half lives, politicians and all, etc., etc. Anyway, I think we're done with regards to the postcodes. So I'm just going to close out the show by turning back to the broader conversation and just make a few final closing remarks. Just remind you, if you haven't liked, please like and subscribe to the show. It really is appreciated. It makes a huge difference to me and what happens. Some of my shows really run quite strongly, others less so. Never really quite worked out why, but I think liking and subscribing really does help. So just to sort of come back to the closing remarks, first thing to say is if you do have financial pressure, and a lot of people do, about half of households, it's important to try and get things under control. So building a cash flow is really important. I've covered this before. Also worth getting financial advice and help, but be careful who you speak with. And I do recommend the National Debt Helpline, 1-800-007-007. And of course, 007 used to be the handle of a very well-known commentator and subscriber of this channel. Cookie will remember, of course, as well. So we remember him once again because he called this out well ahead of time. I still miss him. And also to say that if you are wanting to put some information together, there is this AFCA's Statement of Financial Position document, which is really useful. So you can put your details in, your income, your living expenses, the property, other assets. It's a really good way of crystallizing some of the issues. So it is, I think, useful to refer to that, and certainly encouraging people to get to know your finances better is, I think, a critical discipline. Of course, the other point there is don't just grab more debt. More debt, particularly high interest debt, doesn't help. It actually just makes a problem. Also, if you talk to the bank, they'll kick it down the road. That's maybe helping them, not necessarily helping you. So sometimes it's really important to sort of work out how to actually manage, prioritize what's really urgent, important, what things are nice to have. And, you know, you talk about discretionary spend and mandatory spend. Well, probably food is mandatory, but some of the discretionary stuff that I see people talk about is not necessarily so. Now, if you want to get hold of the data set, we do that via our Patreon program. And it's pretty easy. You just sign up. And we have a number of different tiers. Thank you for all of those who support us via the Patreon program. And it really does make it possible for us to continue to produce these shows. But specifically, if you want to get hold of the data set, you can sign up for $50 a month plus GST. You can sign up for 1 month and just get the data for one time, or you can stay signed up and I'll send it out each month. For those who've signed up already, I'll be sending this data out in the next day or two. So that's how you can get access to it. Or as I said, if you just want one postcode, then you can, of course, always send me an email and I'll try and help there. Just to say that if you want more information about what we do, you can go to the DFA blog. That contains all of our data, a lot of links and a lot of other information. And also, if you go there, you can also contact me directly via the chat in the blog. And again, contact me that way. And by the way, also, I do invite you, if you have got value out of this show and you get value out of our shows and you feel like making a contribution to help us, you can also do it via PayPal as a one-off. It really does help. And again, what I'm trying to do here is to not put paywalls up and things like that, because I think it's really important these conversations are as wide as possible. But the fact of the matter is there are costs involved. And sometimes I do think that people don't understand just how much time and effort is involved in putting all of this material together to be able to actually highlight these critical issues. I think these issues are critical. It should be the cornerstone of the discussion up to the election. And yet the mainstream media and the politicians don't really want to go into the critical issues of migration properly, the critical issues of household income and housing affordability and even rental affordability. And I noticed the Greens, of course, who are on one hand saying we've got to try and protect rents, are also still wanting high migration. So it's nuts. So we're not having a proper debate about these critical issues. As a result of that, over the last 20 to 30 years, Australia's been hollowed out. More people are in difficulty. Half of households have significant pressures. So maybe no surprise that we're in the mess we're in. And like I said earlier on, just to reemphasize, my concern is this translates ultimately into social and economic as well as just property-related issues. And, the social issues, crime, family violence, and I've done some quite significant research showing the correlation between family violence and high levels of financial stress and high levels of mortgage stress, all of these things. So there is unfortunately a bit of a join your dots session here for those who are actually interested in it. Now, before I go, I should say what I didn't say at the front, but I will say it now. We're not providing financial legal advice on this channel. This is a general conversation. And if you would like to use Super Chat, you're very welcome, of course, to that as well. And I just want to say thank you very much for all those who spent some time with us this evening. We've hit the 9:30 mark quite nicely. I'll be on again next time with Leith Van Onselen from Macro Business. And Leith, of course, is very much in this camp that we're now getting to the point where rates must get cut and get quite hard and quickly. So it'll be interesting to explore that with him, and you can ask him a question next week. And we'll be very happy to see you on that live show. And of course, meantime, on our recorded shows, we put out shows every day on finance and property and look at some of the global issues as well as the local issues. But I am very much concentrating on some of these issues relating to the election over the next little while. We should look at the dogs before we go as well. They're still here, looking remarkably quiet. So Luna's now got her back in a basket. She just makes a lot of noise when somebody comes to the front door. Anyway, I want to say thank you so much for spending your time with us this evening. I hope that you've enjoyed and found this an interesting conversation. It's not a pleasant conversation, but nevertheless, I think it's an important conversation. And, finally, I want to say again, if people have financial pressures, there are things that you can do about it. The first thing is to understand where you are. So cash flow, money in, money out, and then make some decisions, talk to the bank, etc., etc. But I unfortunately feel that the rental sector is the sector that we should be talking about a lot more. But no, that's the sector that nobody wants to talk about. They're going to solve it by supply. Well, according to the latest maths, even if we got the 1 million plus homes, it's going to take 20 years to address the supply issue. So I don't think it's going to happen. So rentals are going to be a real problem ahead. Anyway, thank you for that. Have a wonderful evening. Thank you very much for spending some time with us and adjusting for the hour and all of that stuff. I look forward to seeing you this time next week. This is Martin North from Digital Finance Analytics signing off. Say take care. See you next time. Cheerio.